You witnessed it live. Silver didn't just inch higher this week, it exploded. One moment it was cruising near $90, the next it whipped violently, making anyone watching feel their stomach drop. That sudden swing? Not the end, it's just the beginning. Right now, one question dominates the minds of traders, investors, and everyday watchers. Is silver heading even higher, or is this the top? Here, it's the kicker. Forget 95, forget 100. The next level everyone should be aware of isn't T just a number, it has a story in itself. Around $16, silver could trigger a chain reaction of emotion, strategy, and opportunity that few are prepared for. This is the moment where fear, greed, and anticipation collide. And let's get real. Markets are emotional machines. Headlines scream, the crowd chases, FOMO runs wild. But if you know what to watch, if you know the signposts and traps, you can ride the wave without being thrown off. Stick with me, because in the next few minutes, I'll show you exactly why silver is acting the way it is, what history tells us, and what could happen next. By the end, you'll know the difference between panic and opportunity. The real problem most people face with silver is simple. They be unprepared for how volatile it can get. This isn't a market for the faint of heart. When silver broke through $90 this week, it didn't just rise, it whipped violently, swinging up and down in ways that left even experienced traders shocked. Many investors sell too early out of fear, or too late out of greed, only to be caught in sharp pullbacks that feel catastrophic in the moment. Here's the key. These extreme swings are not random. They are the result of leverage, forced liquidations, and emotional trading. Exchanges raise margin requirements when prices surge to protect themselves. Traders using borrowed money get margin called. Sudden selling occurs, creating dramatic dips. Then, once the weak hands are shaken out, real buyers step back in, pushing prices higher again. If you don't understand this cycle, every spike and drop feels like a disaster. The problem is compounded because silver does not move alone. Gold, platinum, and even equities are connected. A sudden move in one market triggers reactions in the others. Late buyers, FOMO-driven retail investors, and hype on social media amplify swings, creating unpredictable whipsaws. Most traders respond emotionally, chasing highs and selling lows, which only fuels volatility further. Finally, there's the psychological trap. When silver nears key levels, like $16 or 106, people think hitting the target means victory. But targets aren't guarantees, they're milestones. Many investors overreact when targets are approached, either by panicking or by jumping in impulsively. The result? Portfolios become unbalanced, positions get overleveraged, and the next sudden swing can wipe out gains in minutes. In short, the problem isn't T, that silver is too risky. It, S, that most participants are ill-prepared for its behavior. Without understanding the mechanics, the psychology, and the broader market context, what looks like opportunity can quickly become a trap. Discipline, planning, and observation are the only ways to survive and profit in a market this intense. Here is what most analysts want to tell you. The next phase of silver yes rally is just about numbers. It's about behavior. Price levels like $16 or 106 aren't arbitrary. They're emotional triggers. They are where the crowd decides whether to chase, hold, or panic. What happens when silver hits these levels? Some will sell, thinking the top is in. Others will chase, believing they've missed the move. And the market, it doesn't care about your plan or your fear. It simply moves. And when it does, it can swing 15% in a single day, just like we've seen. But here was the secret most people overlook. These swings are not to random. They Dunnery signals. Signals that tell you whether the rally has fuel left, whether consolidation is coming, or whether a parabolic top is forming. Miss them, and you're trading hope. Understand them, and you're trading probability. Over the next few minutes, I'll break down exactly what these levels mean, why $1,600 matters psychologically, and how gold and platinum fit into the story. I'll show you the patterns, the technical setups, and the crowd psychology behind every spike and pullback. By the end, you won't just watch silver, you'll understand its behavior, anticipate its moves, and know exactly what to do when the market whispers, shouts, or roars. Silver Yes journey over the past months has been a textbook example of a parabolic move in motion. For years, the metal was quietly accumulating pressure, barely attracting attention beyond the typical precious metals crowd. But 2025 changed everything. Momentum arrived suddenly and forcefully. Volume surged. Traders who had ignored silver for years suddenly found themselves asking, "Where do I buy this?" Even skeptics who once dismissed it were now scrambling, realizing they might have missed a move of a lifetime. The buildup was gradual at first. Price action started showing consistent upward pressure, but nothing dramatic, just steady growth. Then came the moment when momentum truly accelerated. One session, silver ripped through $90, moving with an intensity that left anyone watching glued to their screens. Intraday swings were wild, with highs and lows that made even seasoned traders feel off balance. That volatility, however, wasn't a sign that the rally was over. It was the market testing its participants, shaking out weak hands, and revealing who truly wanted to own silver. The role of technical tools became obvious in this environment. Fibonacci extensions, often dismissed by novices, became signposts. The 61.8% extension, the golden ratio, acted as a speed bump. Price hit it, volatility spiked, traders panicked, and yet the market recovered. This is how a strong market confirms itself. It drops, scares people, and then buyers step back in, proving the rally is still alive. These swings, although dramatic, were part of a natural process in a trending market. Then came the 100% measured move, the full extension. That level, around $16.25, became a psychological and technical magnet. The mid-teens percentage move required to reach it is significant, but silver's recent sessions proved it was capable. Days where the intraday range moved 15% or more weren't T anomalies. They were signals that the metal was acting like a stallion, a market capable of massive gains and equally massive risks in a short period. This parabolic behavior also highlighted a critical structural factor, leverage. As silver rose, exchanges raised margin requirements to protect themselves and reduce systemic risk. Traders using borrowed funds found themselves forced to sell when requirements increased. These margin calls created sharp drops, sudden sell-offs, and panic moments, but they also cleared the market of weak participants. Once that selling pressure abated, real buyers returned, ready to push the price higher again. Crowd psychology played a central role. Imagine selling at $90 thinking you were clever. Suddenly, silver rockets past $97, $102, and eventually approaches $106. That feeling of regret, combined with fear of missing out, drives impulsive buying. FOMO is a powerful force. It pushes prices higher, sometimes faster than fundamentals on yellows would justify, and it's a key ingredient in parabolic moves. This is not a hypothetical. History shows it clearly. Look at 1980 or 2011. Silver didn't gently pull back. It collapsed, often 50-70% from peak levels. Understanding this pattern is critical for anyone participating in the market. But it's not just silver. Gold, the quieter metal, has its own story. Its slower, steadier climb often signals market stability. The story isn't only technical, it's behavioral. Profit-taking occurs naturally in these environments. Investors trim positions, rebalance portfolios, and secure gains. Those actions may appear bearish on the surface, but in reality, they are necessary for healthy market movement. Peaks, pullbacks, and consolidations are part of the rhythm of a trending market. Traders who panic at these moments often lose, while disciplined participants use these pauses to enter or add to positions strategically. Understanding risk management is equally important. Parabolic moves don't reward heroics, they reward planning. Selling in pieces, maintaining core positions, and observing volume, price action, and candlestick patterns allows traders to navigate extremes. Conversely, chasing highs and ignoring trend signals exposes participants to massive drawdowns. Silver's story in 2025 also illustrates the influence of narratives. When mainstream buyers begin asking where to purchase, when headlines shout about new highs, the market responds. Narrative-driven demand fuels price acceleration, sometimes beyond what technical factors alone would suggest. This is where market structure meets psychology. Participants are motivated not just by numbers, but by fear, greed, and the desire to avoid missing out. The story becomes more complex when broader macro factors are included. Global liquidity, margin adjustments, and market rotations all interact to create volatility. Cash becomes a refuge during extreme swings, and optionality becomes power. Traders who plan for these contingencies survive. Those who react emotionally often do not. By now, it's clear that silver's trajectory is more than just price. It is a story of momentum, psychology, leverage, and market structure. Every spike, every dip, every consolidation is part of a larger narrative that repeats across cycles. Those who understand this narrative, who watch behavior rather than just targets, position themselves to capitalize on opportunity while avoiding disaster. In short, the story of silver this year is the story of preparation versus chaos. It's about recognizing the forces at play: FOMO, leverage, crowd behavior, and technical structure. Observing these factors, respecting risk, and acting with discipline transforms a volatile market from a source of fear into an engine of opportunity. This is the essence of the 2025 silver story, a market that tests, teaches, and rewards those who understand it. Here's the reality that most analysts want to tell you. You don't need to predict the future to succeed in silver. You need confirmation. Price is the scoreboard. Behavior is the signal. When silver approaches $16, or roughly $106 in certain measures, that number is more than a target. It's a psychological and technical checkpoint. How the market behaves at that level will reveal whether the rally has fuel left is pausing to consolidate, or is approaching a parabolic top. Let's break it down. Historically, silver's parabolic moves don't just correct 10 to 15%. They often retrace 50% to 70% from peak levels. That's not a scare tactic. It's math. If silver hits $16 and then undergoes a typical pullback, it could revisit the mid-40s or even lower. Understanding this potential risk isn't pessimism, it's preparation. Planning for drawdowns ensures you survive volatility while still participating in gains. Meanwhile, the broader metals market confirms trends. Gold remains steadier, with a target zone in the low 5,000s. Platinum shows upside potential toward $3,600, $3,660 if its trend continues. These metals don't move in isolation. Money rotates, momentum shifts, and market behavior in one asset often signals opportunities or warnings in another. Even equities add context. They may be bullish, but frothy conditions make them vulnerable to sudden reversals. The most critical lesson? Observe behavior over obsessing about the number. A clean climb into $16 signals strength. A sharp spike followed by rapid pullbacks indicates distribution. Volume patterns, pullback depth, and candlestick structure are far more important than chasing a single price. Those who misinterpret these signals often buy emotionally, creating the perfect conditions for market traps. Here's the practical takeaway. Silver may hit $16 and continue higher, or it may pause to consolidate, or it may retrace dramatically. All three scenarios create opportunity, but only if you're disciplined. Position sizing, trimming into strength, and maintaining a core holding allows you to navigate volatility without emotional overreaction. This is why the most successful traders don't chase headlines. They follow structure, respect trend criteria, and manage risk at every step. The final reveal is simple but powerful. The number itself isn't the story. The story is in what happens next. The behavior, the reaction of buyers and sellers, the volume, and the psychological triggers. Watch these carefully, and you'll know whether to ride, hold, or step aside. This is the difference between participating in a historic move and being trapped by emotion. Remember, in markets like silver, survival and profit come from preparation, observation, and execution, not guesswork. Now, I want you to reflect. If silver hits $16 and drops 20% next week, what would you do? Would you panic, hold, or buy more? Your reaction tells me whether you're a participant or a tourist in this market. If you could only hold one metal for the next year, gold or silver, which would you choose and why? Comment your answer below. Real experience and insight shared here isn't just discussion, it's guidance for the community. Share your silver wins, big or small. Even small victories reinforce discipline and confidence. The market is unpredictable, but preparation and observation make all the difference. Here's the loop to remember. Silver doesn't act alone. Behavior at $16 dictates the next phase. How it reacts informs gold, platinum, and even equities. Observation matters more than prediction. History repeats, but only if you watch carefully. Patterns, volume, and psychology signal opportunity or danger. Trimming into strength, respecting trends, and avoiding emotional trades is your roadmap. FOMO and hype will always appear, but your reaction determines whether you swept away or positioned for success. So watch, wait, and act with discipline. Trends reward preparation, markets punish emotion. And remember, every consolidation, every spike, every pullback is a lesson disguised as price movement. Follow it closely, and you'll know when to ride, when to pause, and when to reset.